Hello, my name is Tom Vasella with MRW Financial Brokerage. I appreciate everyone taking the time to log into this webinar, accessing non-qualified annuities income tax-free. Quick commercial on MRW Financial. We're a brokerage general agency based in Tampa, Florida. We really specialize in working with a lot of career agents as well as independent agents. So on the career side, we understand that you have a primary carrier. We can be that outlet for you when your primary products don't always fit. And on the brokerage side, the pure independent side, we provide a lot of marketing support that a lot of independent advisors don't have. In fact, there's some other webinars coming up on how we present long-term care. In this webinar, you're going to see how we talk about accessing those annuities income tax-free, and a presentation tool that we can brand for your agency if you're on the independent side to use in that presentation process. So let's go ahead and get started. You know, a lot of people feel trapped in non-qualified annuities, and I'm a big believer in annuities when there's a purpose for the client's annuity in that financial plan. And there are one of three purposes that I see out there. I get quote requests all the time. I'm the annuity and long-term care specialist here. I get quote requests all the time. Hey, I have a client with $100,000. What's the best annuity? I have no idea. What's the client's goals? What are they trying to accomplish? Those are the things I need to know. You know, is this a person that wants to generate guaranteed lifetime income through some sort of income rider in a pure fixed annuity or a fixed indexed annuity, or even an immediate or deferred income annuity that we're annuitizing? Or is this client more interested in accumulation? What we've had a lot of lately is annuities always lag behind interest rates. So when interest rates dropped because of COVID, annuities, the multi-year guarantee annuities, and we have some as short as 2 years, are far outperforming CDs. I mean, double the interest rate. Other people look at annuities for accumulation for, to get out of the market on the index side. So they have the downside protection in an indexed annuity. Of course, if you're looking at accumulation and capital gains, you may be trading a ordinary income tax trading a capital gains tax for an ordinary income tax, which you're going backwards a little bit, but some people like that peace of mind. Or has this annuity become more of a legacy play? It's safe money that we need in case of an emergency or that we want access to, but really this annuity doesn't have any particular plan other than to pass on to our beneficiaries. Now, if you're looking at that lifetime income, that guaranteed lifetime income, accessing your annuities income tax-free may not be for you because you're not going to be able to guarantee that lifetime income. But I'm a big believer in annuities when you have a specific exit strategy. And if you do have any questions, go ahead and type them in. I'll be happy to answer them along the way. You should know there's currently over $2.2 trillion in annuities in this country. And let's take a look and see how those annuities are being used. And this is limited a study on deferred annuities and the persistency. So they broke it into variable annuities, fixed annuities, and all annuities. Now, what they didn't break down is the difference between non-qualified annuities and qualified annuities. And one of the things I think you'll see is that, or you'll understand that there is a difference between those two. So let's talk first about how many annuities each year are accessed via death or disability. For variable annuities, it's 0.8%. For fixed annuities, it's 1.6%. And for all annuities, it's 1%. How many annuities are actually annuitized each year? For variable annuities, it's just 0.1%. For fixed annuities, it's 0.2%. And for all annuities, it's 0.1%. Now, the partial surrenders, that's where your income riders are going to come in. So when we look at variable annuities, 12.5% are accessed through partial surrenders each year. 17.2% of fixed annuities are accessed through partial surrenders. Of all annuities, that's 14%. Now, that's also where your required minimum distributions are going to come in. So I'd submit to you that when we're talking specifically about non-qualified annuities, the amount that are accessed through partial surrenders is going to decrease. We all have those clients that are forced to take that required minimum distribution. They don't want any. They don't want the taxes to deal with it. They don't want it to increase their Medicare premiums. They don't want it to increase the percentage that their Social Security is taxed at. And that's where we see clients a lot of times with non-qualified annuities. A lot of them feel trapped in that non-qualified annuity because every dollar they take out is, of course, gain and ordinary income, and taxable as ordinary income until they get down to their cost basis. 5.8% are fully surrendered, 4.8% of fixed annuities, and 5.5% of all annuities each year are fully surrendered. And look at this, 80% of variable annuities, 76% of fixed annuities, and 79.4% of all annuities, there's no activity. In other words, all it's doing is it's growing, is gaining value, no money's being taken out, so that deferred tax liability is increasing. Those are the annuities that we're talking about that are, we may be able to access income tax free. Now, think about your own clients. How did they get those annuities? A lot of money managers may have inherited non-qualified annuities, and they don't really want them, but they can't justify the tax liability to get the client out of that. If that annuity was inside an IRA wrapper, it's really easy to liquidate that annuity without any tax consequence and put it into your managed money platform and your assets under management. Not so easy with a non-qualified annuity. So the client may have been sold a non-qualified annuity by a previous advisor, and maybe it doesn't have any specific planning purpose for that client now. And that client and you as an advisor feel trapped in that annuity due to the tax liability to reallocate. Or the client's plans have changed. The client no longer needs the annuity for the original planning purpose. I'll get many times a request, and here's the situation. Husband took option A on his pension, or the pension reduces upon his death, and the spouse is also going to lose a portion of Social Security. So if the wife passes away first, maybe they're fine with the amount of income left for the husband. But if the husband passes away first, it's going to be a lot tougher for the wife. And the husband really wants to make sure his wife is set up with that mailbox money, that guaranteed income that comes in for the rest of her life. So they purchase a deferred annuity. They know the money is there for the wife to replace the decrease in the pension funds, and then the wife predeceases the husband. They don't have a need for that income anymore. They don't have the planning purpose. The original planning purpose for that annuity doesn't exist anymore. And the husband doesn't really want the tax liability to get out of that annuity. Well, what if I told you that this was the hypothetical investment? I'm going to put up a poll here after you hear this investment. I know it sounds too good to be true. Imagine you do the research, you realize that, it's not some sort of Ponzi scheme. It's not some cutting edge, aggressive interpretation of tax code. It's accepted policy. What if we could reallocate 100% of those annuity funds income tax free? They have the opportunity to receive up to 3 times your funds out, 100% income tax free. It's the only way you can avoid, or your beneficiaries can avoid, income taxes on an annuity. If you're an individual over age 65, there's a 70% chance you're going to receive funds out income tax free. If you're a married couple, there's a 91% chance you're going to receive those funds out income tax free. Of course, there is a downside risk. And the downside risk is if you're an individual, there's a 30% chance. If you're a married couple, it's just a 9% chance that you're not going to get those funds out income tax free. You're going to get 100% of all your funds back. How many of you, if you had that opportunity, would offer that to your clients or possibly recommend it to your clients? So I'm launching a poll right now. If I can get as many people to answer, we usually can get up around 80% of the people answering. We're at 42% right now, over 60%. We can get just a couple more people to look at the screen and answer. We're at 68% right now, 73%. Okay, now we're up to 87%. So I'll go ahead and close the poll. And as usual, 100% of the people indicated, yes, this is something their client may be interested in. Well, this is the Pension Protection Act of 2006. And here's what it is, and just hear me out here. It's a 1035 exchange to an annuity that's compliant with the Pension Protection Act. If they are not in a Pension Protection Act compliant annuity, they cannot access those funds income tax free. And it's got a hybrid long-term care benefit. So many clients have chosen, and a lot of times wisely, to not use old traditional long-term care. They have the assets to self-fund long-term care. All right, but there's a cost in self-funding long-term care. If you take the money out of your traditional annuity to self-fund long-term care, that's taxable income. And yeah, you're going to get an offsetting deduction for some of the expenses that are medical related for that. But that's only to the extent it exceeds 7.5% of your adjusted gross income. All right. What if they could pull that money, and if they're talking about liquidating a capital asset with capital gains, now they're paying capital gains tax on something they could receive a free step-up basis if they hold it upon their death. You see, what you have to understand is long-term care, it's not an asset problem. Long-term care is a cash flow problem. If all of a sudden we're going to increase expenses $60,000 to $100,000 a year, how are we going to meet those cash flow demands, and what are the tax consequences of meeting those cash flow demands? Well, here we can take an annuity that doesn't have a specific planning purpose, a non-qualified annuity, and if they need it for long-term care, they get to access those funds 100% income tax free. And for an individual over age 65, there's a 70% chance they're going to need care. For a married couple, there's a 91% chance that one or both of them will need care. It will triple the benefit for long-term care. So if it takes $100,000, and if you use it for long-term care, it will pay out a total of $300,000 income tax-free for long-term care. But if you don't use it for long-term care, the $100,000 still goes on to your children. Now, this isn't about trying to plan for 100% of the long-term care expense. I don't care if it's a $30,000 annuity. That's not going to fully fund long-term care. This is tax planning, though. Let's take this $30,000, put it in a place that if you do need it for long-term care, you can access it income tax-free and avoid those taxes. And those long-term care benefits are, of course, paid 100% tax-free. I don't care. Now, you do have to be a married couple because only a spouse can continue an annuity, but I don't care how your non-qualified annuity is titled. If the husband's the owner, the wife's the annuitant, the husband's owner, the husband's the annuitant, joint owner, joint annuitant, it doesn't matter. We can do a like-for-like exchange and add an additional insured that's a spouse, so we can access those funds if either one of them receive those funds or require care. And again, for a husband, there's a 70% chance if they're over age 65, that husband, the male, is going to require care. On average, for a male, it's 2.2 years. For a female, same 70% chance they're going to need care, but on average, it's 3.7 years. I've been specializing in long-term care and annuities for 30 years now, and I can tell you why there's a difference, why women spend more time with professional paid care than their husbands or spouses. And it's because they live longer. In the early stages of care, gentlemen, our wives are there to help take care of us, and we don't require professional care. Then there's typically a conversation that mom needs some help with dad. He's wearing her out, so they bring in a home health aide. And then there comes another point in time where we just can't manage dad at home anymore, and we go into an assisted living facility. And then, of course, the very end of life is a nursing home. These annuities will fund all of those levels of care: home health care, assisted living, and nursing home, income tax free. So it's the only way to permanently avoid taxes on those annuities that are continuing to defer, and you have a deferred tax liability in the future for you or your family. Here's a way to avoid it. Now, what happens? Us gentlemen usually pass away first, and who's there to take care of our wives? Well, there's no one in those early stages of care. So they're receiving care much earlier in the care cycle because they're widowed typically. And that's the reason for the difference, the disparity between males and females. There's actually a 49% chance that they're both going to need care. And if you do the math, that's 5.9 years of increased cash flow demands. that means there's only a 9% chance that neither one of them will need care. So for a husband and wife, there's a 91% chance they can start to access this non-qualified annuity income tax-free. Now, what does that mean? It means it doesn't count against provisional income and how much of their Social Security is taxable. It doesn't increase their Medicare premiums. Of course, they don't pay taxes on it. It doesn't have affect the 3.8% surplus tax. There's a lot of consequences if you're trying to create cash flow out of assets. Here we can take an asset that's normally subject to ordinary income taxes, reallocate it income tax-free for a planning purpose that may not be addressed. Again, we're not talking about insuring necessarily. They're self-insuring the first $100,000 in that example that I gave you, because their $100,000 will be spent down first. What then happens, though, is if that annuity is exhausted and you've accessed all of those funds income tax-free, there's another $200,000 that will continue to pay before you move on to your other assets. So it's just a more intelligent and tax-efficient way to self-fund your long-term care. So let's look at an actual case example. Here's John and Mary Smith. They're both age 80 years old. They purchased a non-qualified variable annuity April 24th, 2006. The initial premium was $118,964. The current accumulation value is $181,964, and they have no specific planning goal. Now, this is the tool. I'll email out everyone that's on this webinar, not only a recording of the webinar, but a sample of this. This is the tool I was talking about, that if you're an independent advisor, we can rebrand it for your agency. We're happy to work with your broker dealer if you'd like to help you get it through, get compliance approval on it. And it's, can you access non-qualified annuities income tax-free? And we're going to ask them 3 questions. Question number 1 is, do you own a non-qualified annuity that has increased in value? If they don't, you can stop there. You can move on to another planning topic. But let's assume the answer yes to that. What specific planning goals is this annuity going to fund? Now, as their advisor, you probably already know that, but if this is a new client that you're talking to, you need to understand, what are they going to use this annuity for? Many times you'll hear, oh, it's just an emergency fund, and then I might volunteer. So if you needed it for long-term care, this might be an asset you'd use for long-term care. They can sort of earmark it in their mind for long-term care. We're halfway there. And question number 3 is, if it's possible for you to access these annuity funds income tax-free, would you like to know more about it? I think most people would indicate yes, they'd like to know more about it. So in this presentation tool, there are 3 fact finders. This one happens to be for a variable annuity. There's also one for a fixed indexed annuity and a fixed annuity. And what I recommend you do is you pick up the phone, or, if you're doing social distancing and meeting them through a Zoom meeting, you conference in. I was with an advisor on the phone yesterday. We conferenced in Athene, Equitrust, and American Equity. We're doing a 1035 exchange on 3 different annuities over this product. So we needed to find out, this information. I recommend you call in or conference in with the client on the phone so they can hear this information directly from the carrier. So we ask them, on your existing variable annuity, of course, we know what the insurance company name is, the date of call. We want to know who we speak with. You have to give me what is their assumed income tax rate. If they were to cash in this annuity, or if it's all three annuities, absorb all of this taxable income, $60,000 to $100,000 a year for increased cash flow demands for long-term care, what would their income tax rate be at that point? What's the annuity issue date? What's the cost basis of the annuity? Don't just ask how much premium went in, because I've found a lot of the annuities were 1035 exchanged from an annuity prior to that. So what is the cost basis of the existing annuity? And if there are withdrawals, we need the dates and times of the withdrawals. The dates and amounts of the withdrawals, I'm sorry. In that case, there were no withdrawals. We have $181,000. It's out of surrender charge, and the death benefit happens to be the same as the account value. We also want to know other things, because we want to make sure we're not giving up any tangible benefit that is important to the client. If there is a death benefit, this one happened to be highest market value. We were at the highest market value. How do withdrawals affect that? Because we may not withdraw the entire annuity. It may be a partial 1035. Is there a guaranteed minimum income benefit or guaranteed minimum withdrawal benefit? How much is that guaranteed lifetime income today? We'll compare that to annuitized annuities to see if there's any real value to it. If they are considering taking the income, this may not be appropriate for them. We also want to know what the fees are. In this case, the fees are only 1.45% plus the fund management fees. So it's an annual cost of $2,638. You get all of that information, get it back to our office, your back office. That's how you position us. And we're going to put together a report. But let's move on through that appointment, that first appointment in that presentation. So now, Mr. and Mrs. Smith, I have another question for you. Do you have a plan to fund long-term care expenses? We want to know if they have an existing long-term care insurance policy, especially if it's one of the old traditional policies that's use it or lose it for long-term care. And are you aware that over age 65 as an individual, there's a 70% chance you're going to need care? If you're a married couple, you're over here, there's a 91% chance you're both going to need care, only a 9% chance you won't need care. We want to establish that in their mind because we want to show them, that they're very likely going to require care and be able to access the funds income tax free. So question number 5 is, given the 70 to 91% chance, and you'll know whether you're talking to a married couple or an individual, of accessing your annuity income tax free, is it worth investigating this planning solution? And this is important, Mr. and Mrs. Smith. It's not your money that allows you to get this, it's your health. It's your health. And what I mean by that is there is some underwriting involved. Now, I don't want to present something to you that your health may disqualify you from. So what I want to do is collect some basic health information. And if they answer no to these 5 questions, we have a planning solution for them. We can probably double their money for long-term care, and they can access it income tax-free. And that's in the past 2 years. Have you been confined to a nursing home, assisted living facility, hospice care, been advised you have a terminal illness, or do you have any issues with activities of daily living? Do you need assistance with your activities of daily living? Question number 2 is, are you currently hospitalized, bedridden? And this will get a lot of people. Do you use any assisted devices, such as a wheelchair, walker, dialysis machine? Single-legged cane is okay. A quad cane is not. Or do you take any of these memory drugs? Question number 3. Have you been diagnosed with AIDS, HIV? And actually, we've had people issued, there are people now that the AIDS virus in them is undetectable because of the medical regimen. If that AIDS virus is undetectable, we can get a policy issued for them as well. And if you're under age 65, are you able to work? If you're receiving Social Security, disability, or any sort of disability payments, unfortunately, you're not going to be able to qualify. And the final question is the dreaded diseases, the Alzheimer's disease, multiple sclerosis, multiple dystrophy, ALS, Parkinson's disease, or active cancer. If you're clear of cancer, we can get you a policy. If the cancer is still active, we're going to have a little bit more of an issue. But what we want to do is also go on and collect some more health information, because there may be some products that are not simplified issue that are fully underwritten that might be more aggressive depending upon the client's situation. But here's what I'd like to do. I'm going to take this information and I'm going to send this to my back office, the back office being me here at MRW Financial. So I need to know, I'm going to have them prepare a report and make some recommendations for us. So I need to let them know when they have to have that report available. So if I can set the date and time, let's go ahead and set the date and time of the next meeting. And here's what they're going to do. They're going to take out of the 2,000 insurance companies that are out there, 200 that have an A- rating or better, 100 have been in business for 100 plus years, 30 of them approximately have policies with long-term care riders. They're going to nail it down to 3 finalists with a recommendation of which one makes the most sense for you. It's not a one-size-fits-all approach, depending upon your age, depending if you're married, depending if you want to, there are some solutions for qualified money as well. It's not part of this presentation, but a lot of those factors will depend on which product, which carrier makes the most sense. And in the next meeting, all we're going to do is we're going to review our findings. No money's going to change hands. Our goal is to see if any of these options make sense to you, and if so, we'll discuss the process for submitting your health information to the insurance company so we can make sure it's a real option. We want to get you approved. That way, if you decide you want to move forward, you can. So if all of that makes sense, let's go ahead and set a time and date for our next meeting. So you're going to send that information to me, that their health information as well as their existing annuity information, and I'll prepare this report for you along with some product recommendations. So this is a comparison for John and Mary Smith. They were both 80 years old. They purchased the annuity in 2006. It grew from 118,000 to 181,000. We calculated their net annual rate of return after all fees was 3.35% in this annuity. We're going to take that 181,000, do a 1035 tax-free exchange, and we can turn it into an after-tax benefit of $6,065 a month, a total of $545,000. Now, if they wanted to get out of that annuity, because they already have $63,000 of taxable gain, if they wanted to get out of that annuity $545,000 after tax at that 35% tax rate, and you tell me what tax rate to use, they'd pay $230,124 in taxes. So they'd actually have to grow that to over $775,000, that $181,000, to get that same amount of income tax-free benefit. To grow it to that amount, here's the rate of return. If we go all the way out to age 95, you'll see they need a 10.2% rate of return. And remember, their current rate of return has been just 3.35%. So it really starts to make sense. Oh, and by the way, if you don't use this, the entire value is still going on to your kids, your beneficiaries, with the same income tax consequences. This particular annuity, this happens to be the 4Care annuity from Global Atlantic. And this is the guaranteed page. Currently, it's paying just 1.75% interest. So on that $181,000, you'll see in the first year, it's $3,151. Again, this is the guaranteed page, so I'm assuming it's going to drop to the guaranteed minimum interest the next year of just 1%. Now, look at that rider charge. That's the cost to triple the benefit, $5,459. But is the client really paying that? Because this particular annuity has a guaranteed return of premium. So look, the contract value and the death benefit never goes down. So even though the rider charge is $5,459 and it's higher than, look at in the second and third year, the $1,800 in interest is being credited, the contract value doesn't go down. So what's the real cost for this client? Well, the cost is the 3.35% that they've earned on their other annuity. It's an opportunity cost. The money's not going to grow at that 3.35%, which is, of course, a taxable rate. But for that, what are they getting? Here's the long-term. Oh, no, I'm sorry. It has 9 years worth of surrender charges. In the 10th year, the $181,000 is completely liquid. Now, what are they getting for this? They get, of course, their $181,964, an extended benefit for long-term care of $363,000, so a total long-term care benefit of $545,000. They have a $6,065 a month benefit, and that is per person. So if both husband and wife are on claim at the same time, it's going to pay $12,000 a month. Okay, the pool of money, or the $545,000, is a single pool of money. So it's going to be spent down quicker at $12,000 a month than $6,065 a month. But again, we turned $181,000, $63,000 of which is taxable, into a $545,000 income tax-free benefit that they can access each at $6,000 a month. It's a tremendous benefit for your clients. The current annuity, so just to recap the Pension Protection Act, the current annuity is a 1035 exchange compliant annuity, immediate 3-time leverage for long-term care. The individual, 70% chance need in long-term care, 91% chance for a couple. And again, the downside risk is 100% guaranteed return of all funds. That's the Pension Protection Act of 2006. Once again, my name is Tom Vassallo. This is my contact information. We did have a couple of questions So if I can just go through this. Also, please let me know if we have a wholesale sales agreement with our Mass Mutual. We work with Mass Mutual advisors all of the time. You have to get it approved as an outside business activity. Most of these products are true fixed annuities. There is one indexed annuity out there on a chassis. Obviously, as a Mass Mutual, Northwestern Mutual, principal advisor, you aren't able to sell fixed indexed annuities outside the broker dealer, but these fixed annuities you are. And I can talk you through that process and how you get approved for that with your broker dealer. If there are no other questions, I appreciate everyone taking the time to be on this meeting. I'll go ahead and send out to everyone. I'll probably go out tomorrow a sample of that Pension Protection Act flip chart that you can have branded to your agency. Just call our office, ask for me or ask for Lauren. She's the one that can brand it for you, as well as a recording of this webinar. Thank you, everyone, for the time. Have a great day.